Hello, everybody, and welcome to the series of videos explaining some accounting concepts at beginner level, starting off with definitions, moving on to debits and credits, and then lastly finishing off with some examples. So if you are the type of person who would like a beginner understanding of accounting but doesn't really know where to begin, then I assure you you're in the right place. And hopefully by the end of this video series, you will not only have a love for accounting, if that's possible, but you would at the very least appreciate the subject matter. So on the menu for today, we'll be looking at the building blocks or the so-called language elements of accounting, being the definition of an asset, the definition of a liability, the definition of equity, and finishing off with how those elements relate to each other in terms of the accounting equation. So let's jump straight into it and let's start talking about the definition of an asset. So the formal definition says that an asset is a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow to the entity. I will see that there are a lot of words happening there. Not all of them critically important. There are a few concepts in there which we need to deconstruct and analyze with a little bit of detail. So let's start off with the first concept, being a resource. So a resource is something that gives you access to future economic benefits. So it is not an economic benefit on its own. It gives you access to those benefits. And within the context of our example being a delivery vehicle, as we can see there, rolling on 21s, looking good, resource in the form of a vehicle gives you access to performing delivery services. So those future economic benefits would be the benefit of being able to deliver goods to clients, deliver inventory from one branch to another branch, etc. And hence, it provides us access to those future economic benefits. The best non-accounting example that I can think of would be gym membership. Unfortunately, we all can't get into shape by just buying gym membership. We have to actually go into the gym and do the work to get the actual benefit. So in the same way, a motor vehicle or a delivery vehicle on its own, not much use to us unless we go out and actually do the work. So it is a resource that is potential for economic benefit. We then look at the concept of control. Control relates to the concept that says we control or we exclusively have access to the future economic benefits that would come from this delivery vehicle. So nobody else could come into our business and say, hey, buddy, I'm using your motor vehicle. I'm going to make deliveries whether you like it or not. It's our vehicle. We maintain exclusive control over those benefits, and only we can make the deliveries as and when we need to. Then look at the concept of past event. So a past event, meaning something had to have taken place for us to be entitled to those future economic benefits. In this case, within the context of our delivery vehicle, it would be something along the lines of typically walking into a dealership, signing the papers, and taking ownership of the vehicle. Once we have that vehicle, we can then do with it as we please. We then come to the last element, which are future economic benefits. And as we said earlier, those relate to the benefits that come from owning the resource. In this case, it would be, like I said, the ability to deliver to clients, the ability to deliver goods from one branch to another branch. And that brings us to the end of the definition. So let's quickly recap and see if a delivery vehicle meets the definition of an asset. Is it a resource? Yes, it gives us access to future economic benefits in the form of deliveries. We maintain control over that ability to make deliveries. The past event that entitles us to those future economic benefits would be the purchasing of the vehicle and taking ownership. And those future economic benefits, as we said, would be to make deliveries themselves. Okay, so I'd like you to think about some other items that you would see in your normal everyday life, things like buildings, things like desks and chairs, things like computers, and assess for yourself by applying the definition whether those things would be categorized as assets or not. All right, so let's move on to the next element, which is the definition of a liability. So the formal definition reads that a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Once again, a lot of words happening there. Just three concepts to be conscious of. First one being the concept of obligation. So an obligation implies that there is something that we have to do that we don't really want to. So within the context of our example being a bank loan, we have an obligation to pay back that money once we receive it, of course, whether we like it or not. So that obligation, once we go to the banker and say, hey, Mr. Banker, can we get some money? The banker then says, yes. We receive that money and we immediately have that obligation to pay back that money at some future date. Second concept is the past event. Similarly to the definition of the asset, something must have taken place in the past within the context of a liability to not create future benefits as with the asset, but instead to create this obligation within the context of the liability. So something must have happened that created this obligation. And what happened to create this obligation? What event took place? That event would typically be signing the loan agreement and receiving the cash. So the moment we sign the loan agreement and receive the cash, we are now obligated to pay back that money at some future date. And then lastly, of course, that would result in an outflow of resources because the cash and revenue, the benefits that we obtain from our assets, some of those benefits would have to go to the bank. We will no longer be entitled to those benefits. And of course, that results in an outflow of resources. So once again, I'd like you to think about some other items that you come across in your normal everyday life and apply the definition, apply those three elements and see if you can arrive at the conclusion as to whether they are liabilities or not. So things like credit purchases of inventory, things like receiving services for wages that you haven't paid as yet. And those are some of the things that you would expect to see in a normal everyday business. We then move over to the last definition, which is the definition of equity. The definition of equity is pretty short and quite simple to understand. It says that the equity is the residual interest in the net assets of an entity, meaning what is left over after the liabilities have been deducted from the assets. So when we speak about residual interest, we're speaking about what's left over. Net assets, once we receive everything that we have in the business and we pay over everything that we have to pay in the business, what is left? What is left is what belongs to the owner, and that in essence is the owner's equity. Okay, there are a number of things that affect owner's equity. In essence, these are the new things that come across in a business. So for instance, your income would result in an increase in equity. So typically, more income, more cash, meaning more entitlement to the owner, and increase in equity. Expenses, exactly the opposite. Decreases in equity, meaning outflow of cash, less entitlement to the owner, hence a decrease. We then have what we call capital contributions. These are amounts that are paid directly by the owner into the business, hence increasing the amount that the owner is now entitled to. And then lastly, the opposite of capital, meaning drawings, where the owner would remove or take out money from the business, meaning that the equity, the worth of the business then decreases. So in essence, equity is a function of assets and liabilities. If you understand the asset and liability definition, the equity definition is simply the difference between the two. And then lastly, let's look at how these elements speak to each other in terms of the accounting equation. Now, this is something that you've probably seen before. It is a mathematical formula that says your assets are equal to your equity and liabilities. So in essence, you have assets and the equity the equity relates to the entitlement of the owner to those assets, and liabilities relate to the portion of entitlement to those assets that come from external parties. So if we look at our example, purchased a delivery vehicle on credit for 10,000 Rand. Here in South Africa, we use Rand, so just bear with us on that currency, which may not be too familiar to you. And if we complete the table, you'll see that purchase a delivery vehicle, an increase in assets because we have a new delivery vehicle, but we also have an obligation to now pay that money back, hence an increase in liabilities. So that brings us to the end of this video. Thank you very much for watching. Video 2 will be hosted by my colleague, Mr. Hussein Kubadia. Hope to see you then. Thanks a lot. Take care. Bye.